Getting started with investing is like going to the gym for the first time. It's kind of intimidating. There are a bunch of people who seem like they know exactly what they're doing, and you're just there, trying not to embarrass yourself by dropping a weight on your toes. Stick to the basics. For beginners, the trick is to start simple. You don't need to understand what a collateralized debt obligation is to get started. And frankly, there are a bunch of finance pros that probably couldn't explain that one sober. Retail investment platforms. Nowadays, there's an abundance of investment platforms that cater to the everyday person. No suit and tie required. Apps like Robinhood, Acorns, or even Cash App lets you buy stocks with a few swipes of your finger. The key here is to get involved with platforms that don't pile on fees that eat into your gains, or in some cases, your capital. Index funds and ETFs. When you're just stepping into the ring, your best coach might be an index fund. These funds are like the buffet of the investing world. They give you a little bit of everything in, say, the S&P 500, so that your success isn't riding on one company's stutter step. If one stock goes down, others go up, and your risk is spread thin like butter on toast. ETFs, exchange-traded funds, are similar to index funds, but they trade like stocks, so you can buy and sell them throughout the day. Robo-advisors. Now, for those who have less time or just don't want to get their hands dirty, robo-advisors could be your golden ticket. You throw money into an account regularly, and these robots, which are less likely to rebel and take over the world, more likely to diversify your portfolio, will manage your investments for you. The power of compound interest. The one big high-five strategy in investing is to start early, because Father Time is actually on your side for once. Compound interest is the snowball effect of money. Imagine rolling a small snowball off a mountaintop and watching it grow as it barrels down. That's your money with compound interest, and the mountain is time. Consistency over timing. Some folks treat the stock market like betting on horses. That's called timing the market, and it's about as reliable as a chocolate teapot. A better strategy? Dollar cost averaging. You invest a fixed amount of money regularly, no matter what the market is doing. It smooths out the bumps and can potentially lower the average cost of your investments over time. Education. And sure, eventually you'd want to learn a bit more about what you're doing. But don't throw yourself in the deep end with options calls and futures trading. There's a plethora of investment books tailored to beginners. Consider The Little Book of Common Sense Investing by John C. Bogle, or The Intelligent Investor by Benjamin Graham. They are to investing what Dr. Seuss's ABC is to literature. Patience is a virtue. Finally, investing isn't a get-rich-quick scheme. It's a get-rich-slowly scheme, like planting a tree. It starts small, but given enough time, you get a sturdy oak, or at the very least, a reliable apple tree. Portland perspective. Being out here in Portland, Oregon, you might think my investing advice should involve something cutting-edge or sustainably cool, like startups carving wooden tech gadgets in the Pearl District. But the truth is, no matter where you live, from Portland to Peoria, the principles of starting with investing remain the same. Remember, stick to the basics, use the tools available, trust in the magic of compounding, and stay consistent. Now go make your future self say thanks.